if you get to be 65 or 70 and later, and the people that you want to have love you actually do love you, you're a success.
What are Warren Buffett's investment strategies? Buffett benefits from dividend reinvestment, compound interest, and the ability to continuously reinvest operating cash flow from Berkshire's businesses. What level of strength is this? Compared to the S&P's 500 10.5% annualized return, Berkshire has averaged a 20.1% annualized return since Buffett took over in 1964. Often referred to as the Oracle of Omaha, Warren Buffett is well known for having extraordinary investing sense. Through his investment philosophy, which consists of a set of rules and equations that have guided his road to financial success, he has shared a wealth of knowledge. It would be oversimplifying to try and distill all of Buffett's accomplishments into a handful of formulas, but there are a number of important formulas and ideas that he has shared with the world that provide insightful advice for investors and anyone hoping to become wealthy. Intrinsic value assessment is one of them. The evaluation of a company's intrinsic worth forms the basis of Warren Buffett's investment strategy. It entails projecting a company's future cash flows and discounting them to their present value, although there isn't a single formula for this. Although there are several ways to calculate intrinsic value, the basic method involves projecting the future earnings of a company in a reasonable manner and discounting those earnings to account for risk. Benjamin Graham invented this idea of value investing, which is the cornerstone of Buffett's stock market success. Graham's methods made extensive use of statistical analysis. Conversely, Buffett combines an understanding of the business's operations and management with a thorough grasp of financial analysis. Buffett is a value investor who looks for stocks that the market has undervalued and holds onto them for the long run. This method seeks to evaluate a company's prospective future performance in addition to its past and present performance. Worth investing is a well-researched strategy that emphasizes the inherent worth of assets and the company's potential for long-term growth. It also lowers the risk of capital loss and has a solid track record. The Rule of 72. Buffett frequently applies the Rule of 72, a simple formula that determines how long it would take for an investment to double in value. Divide 72 by the yearly rate of return to find this rule. To double your initial investment, for example, you would need to wait about 7.2 years, 72 divided by 10, if you expected a 10% yearly return on your investment. Margin of safety. Buffett often talks about how important it is to keep a margin of safety in your investments. Buying stocks or other assets at a significant discount to their true value is a wise way to minimize risk, even if there's no exact formula for doing so. Benjamin Graham created the idea of intrinsic value, which is the estimated true value of a business. Investors can assess whether a firm is inexpensive and worthwhile to invest in by computing its intrinsic value. Buffett thinks that preserving a margin of safety is crucial to preventing future losses. Put differently, his objective is to purchase assets at a lower cost than their inherent value, with the intention of mitigating the risk of capital loss. An extensive examination of a company's financial data, including earnings, cash flows, and assets, is necessary to determine its intrinsic value. Some methods for estimating intrinsic value include discounted cash flows analysis, price-to-earning ratios, and book value. This intrinsic value can be computed by using many methods of valuation. Investors can make more informed judgments and avoid overpaying for assets by concentrating on intrinsic value and keeping a safety margin, which guarantees they purchase the assets at a fair value. The sustainable growth rate. Buffett is a frequent supporter of investing in businesses that have a long-term competitive advantage. A metric called the sustainable growth rate is used to determine how quickly a business may increase its earnings without taking on excessive debt or diluting its stock. The percentage of earnings held back for reinvestment is shown by the retention ratio. This technique makes it easier to find companies that have room to develop in the long run. SGR equals return on equity times retention ratio. The price-earnings ratio. Buffett views the PE ratio as an important statistic in stock appraisal, even though he doesn't rely on it exclusively. Buffett is ready to pay less for every dollar of earnings, thus he typically favors companies with lower PE ratio. The PE ratio equals the stock price over earnings per share. The owner earnings formula. Owner earnings, a gauge of a business's true profitability for shareholders, was first proposed by Buffett. Buffett uses this calculation to assess a company's capacity to produce cash for shareholders after taking the required reinvestments into consideration. Warren Buffett's investment strategy is based on these equations and ideas, and it's imperative to acknowledge, nevertheless, that prudent investing necessitates discernment, endurance, and a deep understanding of companies and sectors. Buffett's success is a result of his methodical, long-term investing strategy rather than just these methods. Owner earnings equals net income plus depreciation plus amortization minus capital expenditures. Warren Buffett's concepts of value investing, long-term investment in companies he knows, and grabbing chances during times of crisis are credited with his success in investing and amassing money. Buffett started out in early 1950s as an investment salesman, and in 1956, he established Buffett Associates. 1965 marked the year he took over as CEO of Berkshire Hathaway, less than 10 years later. In June of 2006, Buffett declared his intention to give his entire fortune away to charity. The Giving Pledge initiative was subsequently launched in 2010 by him and Bill Gates to inspire other affluent people to engage in philanthropy. Buffett adheres to value investing philosophy of Benjamin Graham. Value investors search for stocks whose price relative to their inherent value are absurdly low. Although there isn't a single widely accepted technique to calculate intrinsic worth, it's typically calculated by looking at a company's financial statements. A value investor looks for stocks that aren't identified by most other buyers or that the market believes are undervalued. Buffett raises the bar for the value investment strategy. The efficient market hypothesis, which contends that stocks always trade at their fair value, is a theory that is opposed by many value investors. This makes it more difficult for investors to sell their stocks at inflated prices or purchasing them at a discount. They do believe that quality stocks that were temporarily discounted will eventually begin to be favored by the market. As a strategy for achieving success, Warren Buffett has consistently emphasized the value of investing in oneself. This entails developing your expertise in the fields you want to participate in, as well as making wise financial decisions. Don't worry about the subtleties of supply and demand in the stock market, because Buffett, well, he doesn't give a damn about what goes on in the stock market. The implication of his well-known translation of Benjamin Graham's quotation is as follows: "The market is a voting machine in the short run, but a weighing machine in the long run." The text reads, "To shareholders of Berkshire Hathaway Inc., 1987. He selects stocks based only on a company's entire potential because he views each one as a whole. Buffett does not hold these stocks as long-term investments in order to generate capital gains. He is interested in investing in high-caliber businesses that have enormous revenue potential." A key component of Buffett's investing strategy is his long-term outlook. He can ignore short-term market swings and concentrate on the core growth and profitability of his assets by taking a long-term perspective. By taking into account the fact that firms grow and change over time, this strategy enables investors to take advantage of compound interest. Having a long-term outlook does not, however, imply disregarding transient market turbulence. It involves instead making fact-based, logical financial judgments as opposed to giving in to emotions aroused by sporadic market fluctuations. By keeping a long-term perspective, investors are better positioned to take advantage of opportunities during market downturns and avoid making snap decisions in response to market volatility. Buffett takes into account a number of variables while assessing profitable investments, including competitive advantage, managerial caliber, firm performance, and value. Through the examination of financial statements and their associated measures, one can acquire a deeper understanding of a business's capacity to produce steady earnings, control costs, and enhance shareholder value. It's crucial to remember that past success does not ensure future success. That's all for today. If you liked this video, please give it a thumbs up. Make sure you subscribe to our channel and hit the bell icon to receive notifications. Also, express your valuable thoughts in the comment section below. Until then, this is goodbye, and also spend some time watching some other videos